Good morning, everyone. It's Friday, May the 22nd, and welcome to 7 Investing Live. This is our live stream event we host every Monday, Wednesday, and Friday at 9 o'clock Central Time, 10 Eastern, to put a spotlight on several of the stock market's most intriguing opportunities. My name is Simon Erickson. I'm founder and CEO of 7 Investing, joined by our executive producer of the show, Heather Horton. Today is Best Buy Day. We are going to be publishing our 5 best buys for May to all of our 7 Investing subscribers. You can actually see them for absolutely free because if you sign up at 7investing.com/subscribe, you get to see all of our recommendations. You get to see all of our monthly best buys, including those that are coming out here this afternoon, and all of our premium content free for your first 7 days. No strings attached, no obligations, none of that marketing stuff. This is if you want to see some stock picks and some good ideas right now here in May, come check out 7investing.com/subscribe. On the note of it being Best Buys Day, we go through the entire scorecard. We go through over 120 active recommendations, and we say, okay, which of those are the top 5 every month? What are the ones that we want to feature this month? But let's kind of do a comprehensive scorecard review. And in this, there's nuggets of interesting insight that tends to bubble up. And I wanted to share one of those today when we talk about fast casual dining. And in fact, in this sector of the market, it's interesting to see that one company is really eating another company's lunch. And we're going to get into that in just a moment. We've seen this in the past. Heather, you and I were discussing before the show what a market darling Chipotle had been for the last decade. Probably one of the simplest concepts. You're putting food out, you're preparing it, and you're serving it to people. But this was a stock that did very, very well for the last decade or more. And now it's got a little bit more competition. And so today we're going to compare and contrast the first quarter results of not only Chipotle, our market darling, but also a new up-and-comer called CAVA Group, who recently IPO'd here very recently in the last couple of years. Now some competition in that same fast casual space. It's not just Chipotle's to exclusively own it. So it's going to be kind of a quick show, but then we'll kind of bounce it back and forth and kind of talk about this space. It's an interesting space because you can get some really good compounded returns in fast casual dining, right? It just works. You boost margins over there over time, and you get more and more traffic, and it just kind of consistently prints out cash flows for investors. And I think that's what worked well for Chipotle. But let's dig into this a little bit deeper. As my kids always like to say, Dad, I've got good news and bad news. Which do you want? We're going to start with the bad news first this time. We're going to look at Chipotle's first quarter results. This was straight off the press, last month, April 29th, Chipotle comes out and it says, hey, we've only got 0.5% comps. Comparable restaurant sales growth of 0.5%. Overall revenue increasing 7.4%. And look at the operating margins declining too. 12.9% down from 16.7%. And then a dip in the overall adjusted restaurant level operating margin down to 23.7%. Of course, then accordingly, earnings per share were down. And kind of a disappointing report for a lot of people that were used to Chipotle just consistently knocking it out of the park. This is something that we're used to seeing much better than 0.5% comps from a company like Chipotle, and the earnings going negative. What's going on? This is not a unique situation. In fact, a lot of the restaurant industry right now has kind of been struggling for the past 12 months or so. Not only are ingredient prices going up because of inflation, but just consumer discretionary, as we've discussed several times on the show, has been in kind of a funk, right? Maybe if you're paying a lot more money at the pump for gasoline and you've got your own expenses for other household items going up because of inflation, maybe you don't want to, go once a week out to eat for lunch at Chipotle. And so a lot of these restaurants, Chipotle included, are saying, hey, we're kind of feeling the heat here. We're getting a little bit more money on price because we've been increasing prices, but we're probably really suffering in traffic. And that's the same thing that Chipotle's been having as well. And if we scroll down, this is not just what they expect to be kind of a short-term thing anymore. This is going to be something that is going to happen throughout the rest of the year, right? For 2026, management is saying full year comps that are going to be about flat. And it doesn't seem like there's a whole lot of optimism based into the Chipotle forecast. Certainly not what we've gotten used to seeing. This is something that we're going to maybe give them a little bit of a hall pass because, well, yeah, this is a tough time. We understand that, maybe people aren't spending that much money. But here's the one that stands out to me, because we saw that in a lot of other restaurants that were similarly using the same excuses. Tough economy, tougher consumer discretionary, inflation, all the usual suspects. But then look at CAVA Group here. And for those who might not be familiar with CAVA Mediterranean Grill, It's very similar to Chipotle. In fact, it even has the same letters and the same acronym for it. It was kind of in many ways, very similar to that same fast casual. You go through, you pick out the ingredients you want, but this is much more of a Mediterranean flair. You've got hummus, you've got tzatziki sauce, you've got gyro meat, things like this that is not necessarily directly applicable to something like Chipotle, but it's the same concept. This was very popular, Heather, as you know, up in Washington, D.C., where they started, where I spent several lunches over there at CAVA Group. But look at this. Whereas Chipotle is churning out 0.5% comps, which they're expecting to be flat for the year and negative earnings, CAVA is coming out here and saying, we have right now same restaurant sales in the first quarter of 9.7%, 9.7% comps versus 0.5 for Chipotle. And look at this guest traffic growth of 6.8%. That was something that really stood out to me, because if you can get traffic, that's not just that you're increasing prices to offset inflation. You're getting organic, more people into the restaurant each and every quarter, each and every year. And they've done that while maintaining a very, very healthy, pun intended, restaurant level margin of 25%. That's basically at parity with where Chipotle is today. The average unit doing $3 million per store, that's sales per store per year. That's very, very good too. And so you kind of see CAVA now opening more and more restaurants. They've got a 20% increase in their restaurant count year over year. Still a much smaller footprint than Chipotle, but you also see net income looking really good. Adjusted EBITDA up 37% year to year over year. And then even free cash flow, even after you're paying off all of those capital expenditures for the new restaurants. And then this I thought was just equally as impressive when you look at the full year outlook. Keep in mind that, Chipotle is out there saying, hey, tough economy, 0% comps, basically flat for the full year. CAVA's out there increasing its own same restaurant sales growth forecast from 3 to 5% to 4.5 to 6.5%. And you can kind of see it maintaining those same kind of really good margins and restaurant openings. This is very encouraging. Heather, at this point, I'd like to open it up a little bit. I'm going to get into some modeling here in a moment that we can chat about that. But when you have a similar sector like this, you tend to see companies mirroring each other, right? They say the same things on the conference calls. They use the same excuses for why earnings are down or why comps are flat. It is a bit unusual to me to see this far of a dichotomy between CAVA doing so well, Chipotle doing so poorly, especially since I still eat at Chipotle all the time. I'm still a big fan, and we know that this has been a really, really good stock to own for the past decade. But it seems like maybe there's a passing of the torch or a changing of the guard here. Just a little bit of a note that is worth pointing out to see CAVA doing so well at the same time that Chipotle really isn't.
Yeah, it's really interesting, and I would love to know why it's doing that. One thing I think that Chipotle's tried really hard in the last couple months to roll out a new healthy menu. They rolled out their chicken snacks and stuff. But Kava's always been a lot healthier. Their sodium levels are significantly lower, and I think in the current diet culture climate, I think that's one of the reasons people would probably lean towards Kava over Chipotle. What do you think?
It could be. You've got salmon now, which is right up, just like you said, it's a healthy option. They just rolled that out onto the menu for CAVA. It does certainly appear like it's considered healthy. It doesn't have the same sodium levels like you said. We've got two that are right next to each other. And it's a higher price point too. If you're looking at Chipotle, a lot of those bowls, $8 or $9, you go right across the street. In CAVA, a lot of those are $12, $13. So same amount of traffic, more revenue, perhaps higher margins. I don't know. I don't know if it's just that Mediterranean is just a little newer and we're getting a little stale and tired of the Chipotle burritos anymore. But it certainly does appear like this is doing much, much better here recently.
Do you know how many Kavas there are versus Chipotles in the US?
Yep, I've got to double check on the Chipotle number, but right now the CAVA count is a 400 and where are we at? 459 CAVA locations. And Chipotle is going to open 370 this year. So it's a significantly more Chipotles that there are out there.
So I also wonder if people are just tired of Chipotle. They're everywhere. We are very saturated in them. And Kava is kind of for a lot of people, not where I live because that's where it was founded, but they're not everywhere the same way. People are going to go out of their way to go find a Kava.
It is interesting about that, right? Yeah, you think of like the traditional guard of the McDonald's and the Wendy's and the Jack in the Boxes, and it feels like those are just kind of, some people are still going to go to those, but we're tired of those. Compared to something like a Chick-fil-A, which has been around since, what is it, the 60s or the 50s, very popular, it's very simple menu, but people just keep coming back. It just works, it just clicks. It's never going to get old. I don't know where Chipotle falls on that. With 0% comps, there's not a whole lot more people going there, but it seems like they're at least maintaining that same loyal customer group.
I also wonder if it's the level of options. Like Chipotle is very good about having a vegetarian option, but they don't. Once again, they don't have a low sodium option. So my husband and I never both eat there because he watches his sodium levels. But CAVA has so many options that I feel like it's a little easier for multiple people to eat at a CAVA than it is at a Chipotle. But that is interesting compared to Chick-fil-A because Chick-fil-A has nothing vegetarian or low sodium or a lot of things going on.
So Heather, let me ask you this before we jump to the valuation stuff. If I give you a $20 gift certificate right now and I say you have to use it on either Chipotle or CAVA, which one are you going to?
I mean, I eat it both all the time. I love them both. I probably CAVA though.
There you go.
I like their falafel.
I would say the majority speaks on the same because we have seen the numbers that CAVA is doing quite well with that. I want to jump in one more thing, as we talk about us as investors, it's kind of nice to see the narratives and what's going on. Let's do some modeling on this also. Let's take a look, bigger picture, at how we figure out what to pay for a company like this. Heather, could you give me a thumbs up if you're able to see that screen? Is that showing up okay?
Yep, great.
Okay, yeah, perfect. So this is kind of, how you figure out what do you want to pay on a per restaurant basis for units like this, right? Basically, the whole concept is the same for Chipotle and for CAVA. You find a replicable format that works, and then you expand as quickly as you can to get as much money as you can out of these restaurants. And through 2025, this is an updated version of the CAVA versus Chipotle model. By the way, we share all of this in our community forum. This is a quick flyby here for the show, but if you really want to get in the trenches with me, and get into all the ingredients one by one, pun intended, jump into our 7 Investing Community Forum. I'll make sure that we get that into the show notes so you can click directly. It's free. Oh, there it is. Perfect. Join. Thank you, Heather. The Join Investing 7 Investing Community Forum. This is where we kind of talk about the investing financials and things like this. But we now have full year 2025 data, and then we're looking at 2026 data, which I just updated yesterday for CAVA. At the top line, it is vastly outperforming the expectations that I had for this stock. It is growing revenue more quickly, 28% versus 20% is what I thought they were going to do for 2025 and 2026, still maintaining at least 20% growth there. And then they've also gone on and added more restaurants than I was expecting. I was thinking they were going to add 70 for the year. They're saying they're going to be between 75 and 77. They're pushing the growth curve quickly. And, when you look at kind of what is the capital expenditure per new location, what's the total CapEx when you consolidate all those together? And then what's the cash on cash return? How much operating level cash flow are you generating per restaurant divided by the cash cost up front that you have to build that restaurant, right? $1.6 million to build a new location. How quickly are you turning that back around? It's actually a really, really good 42% cash on cash return for a business like that. That's fantastic. If you can do that, you keep opening 76 restaurants a year like that. And then you look at the average unit volumes, you kind of work your way down the income statement, the cash flow statements. You look at the margins that you're being generated per restaurant, kind of maintaining that 24% kind of margin out there. Look at a little bit of cash that's on the balance sheet and you say, okay, at the end of the day, how much, let's look at this one from a net income. Let's just look at this in terms of multiples and figuring out, what is the market going to price this at? And that's how we kind of get down here to earnings per share. When you look at the outstanding share count and then look at the PE ratio, I am comparing CAVA's PE ratio to what Chipotle had in its heyday when Chipotle was growing, 20% plus revenue per year or 9.7% plus in same restaurant sales growth. Market loves predictability. We know Wall Street loves things they can model like this, and they're going to give it a very, very high multiple because 40% cash on cash return. You replicate the format of the stores and you just open more of them. And you show consistently that it's working. You are willing to get that 55 PE ratio that Chipotle had for so many years. And so last year, again, this is kind of going back in time a little bit, but when I first valued CAVA here in 2025, I thought that by the end of 2026, the shares would be worth about $69 a share. by the end of 2026, and then $92 a share by the end of 2027. We're sitting, I haven't looked at it here this morning, but I think we're sitting a little bit higher than 70. What are we at, 80? Or if you could pull that up for me, Heather, even to give me on the spot what the number is right now of what CAVA is worth. I think that it is a little bit higher than these.
82.50.
Sorry, say one more time.
Sorry, it's at 82.50 today.
82.50. Okay, so we're a little higher than $70, but it's also outperforming the expectations. So it feels like this is a fairly priced stock based on reasonable assumptions of how well it's growing. And it's outperforming a lot of those expectations in a lot of ways too, right? About a $10 billion market cap, I want to say, is where we're at today, spread across 459 locations. So how much are you paying, per location? $21 million. That's kind of splitting the difference of what we paid for a CAVA restaurant as an investor over the years. And again, the cash on cash return, I mean, just is really amazing. Really exciting to see a company like this building up. So I think my conclusion on this is twofold. One, it's just interesting to see CAVA doing so well when Chipotle is not doing very well in the same environmental climate that we're in right now, same restaurant climate that we're in. But then also, I think that the stock seems pretty fairly valued. I don't think this is a screaming buy right now, but I'd be comfortable buying because they're outperforming the expectations. CAVA looks like a pretty good long growth runway, and they're still opening 75, 76 restaurants a year. I think we got plenty more years of outsized returns, which maybe, call it 12, 14% a year, I think is a reasonable expectation from today's level. If you see a dip, no pun intended for Mediterranean restaurant, but if you see the dip, buy the dip. That's another one you want to get on. CAVA is a good stock to own for a long-term investment.
What should investors be watching for in Chipotle to see if they have a turnaround? Like, what do you think the first signs of that turnaround will be?
I would say it's North American traffic, not necessarily comps, because you can just raise prices to offset inflation. But if you're actually getting more people back in the restaurants again, that's probably the best sign that people are willing to go back out to Chipotle and spend money again. And then the margins, you've got a lot of inflation margins. I would like to see maybe the second one would be, can you boost that restaurant level margin a little higher? It dipped year over year, but maybe you get that back to 26%. It would be a really good sign.
And what should people be watching out for with CAVA?
CAVA's a little bit newer, so I would like to see them grow, to see them raising their forecast for the full year and raising their number of new units they're going to build at the same time. That's really good. It shows that it's working even in new markets, right? It obviously worked in DC really well. It worked in the Northeast where everyone was kind of walking and densely populated. There was kind of a question of, would it work in Texas? Would it work in Houston where Simon is, where people are driving rather than, on foot traffic all the time? It is working. You're getting that same average unit volume of $3 million per store. I think that as long as you're seeing that and it's consistent and replicable, 80, 90, 100 new restaurants a year, because it's going to fall really quick to the bottom line. You're getting a 42% cash on cash return.
It'll be interesting to see if CAVA becomes the next stock darling over Chipotle.
It's been amazing. And, we've looked at this, even McDonald's, what was it that McDonald's has been a 10,000% return or something ridiculous since the 60s if you had gotten it, just because of how well it worked. And the same with Chipotle. Chipotle has been like 1,000% return over the last decade or whatever. I mean, you kind of take for granted restaurants. You think, oh, they just do their thing. It's not a great sign. They can be fantastic businesses to own if you catch them on the upswing like they're doing. And I think that right now, my assessment is best in class is CAVA. We've got others, you've got Sweetgreen out there. You've got, the traditional guard out there, but that Mediterranean niche seems to be working pretty well.
Yeah. And they are delicious. So it makes sense that everyone loves them.
Absolutely. So CAVA is CAVA. If you want to follow along with that one, you can always go to 7investing.com/CAVA if you want to see our coverage on that company. Chipotle CMG, the same thing, 7investing.com/CMG if you want to see all of our coverage on Chipotle. And again, to go full circle back to the beginning of the program, today is Best Buy's day. It's been interesting to see a lot of consumer-facing companies getting walloped in the market right now. We've kind of seen a lot of conference calls, people pointing out how tough of a time it is for the macro economy. But is there opportunity for an investor who's willing to be patient for this to turn around? I think that a lot of these valuations, including the consumer-facing company that was our official recommendation for May, are being unfairly punished and are going to be just fine over the longer period of time. So we'll wrap it up with that for today's show. Again, today is May 22nd. We're going to take off on Monday. That's Memorial Day. A special thank you for anyone who has family or is personally serving in the military right now. Also, a very special appreciation if anyone's lost anyone, very special and important to our hearts. But thank you for everyone that has contributed service to the United States of America. We're going to take off on Monday. We're going to be back on Wednesday. Heather, we're going to talk about Rocket Lab. We're going to do part 2 of Rocket Lab on Wednesday. That's going to be a popular show because we looked at the first quarter earnings last week. Now it's time to get in the nitty gritty and say, okay, what's the shares actually worth? What are you willing to pay for Rocket Lab stock? We'll do that next Monday. In the meantime, have a great day. Have a great weekend. We'll see you next week.